Stop what you are doing right now. Put down whatever is in your hands. Close whatever tab is open on your other screen, and give me the next 25 minutes of your complete and undivided attention, because what I am about to tell you is not a theory. It is not a prediction dressed up in carefully hedged language designed to protect someone's reputation if they turn out to be wrong. And it is absolutely not the kind of soft, feel-good financial advice that gets handed out on television by people who have never actually managed serious money in a serious crisis. What I am about to walk you through is the actual repositioning that Stanley Druckenmiller, a man who has not had a single losing year in over 3 decades of managing money, a man who broke the Bank of England alongside George Soros and made $1 billion in a single day, a man whose macro track record is without parallel in the history of American finance, has already made, he did not debate it, he did not wait for confirmation, he moved. And the gap between where his money is right now and where the average American's retirement savings are sitting is one of the most dangerous gaps in the entire financial landscape. Today, you are going to understand exactly what that gap is, exactly why it is dangerous, and exactly what you need to do to close it before the window shuts. If the information in this video is worth anything to you, and I promise you it is worth far more than you will pay for it here, then do one thing before we go any further. Hit that subscribe button right now. Every single week, I translate what the greatest macro minds on the planet are thinking and doing into language that real people can act on. Private wealth managers charge their clients $10, $20, sometimes $50,000 a year for access to this caliber of analysis. You are getting it here on this channel for free, but only if you subscribe. Do it now before you forget. Now let us get into the work. To understand why Stanley Druckenmiller is sounding the alarm with more urgency than he has expressed in years, you have to understand how he thinks about markets. Because he does not think about them the way your financial advisor thinks about them. And he certainly does not think about them the way the financial media presents them. Druckenmiller is a macro investor. He does not sit in a room studying quarterly earnings reports and debating whether some company's new product line is going to beat analyst expectations by 3 cents. He studies the massive tectonic forces that move entire economies: interest rates, currency values, government debt levels, credit cycles, geopolitical realignments, and then he positions capital to benefit from what those forces are telling him about the next 2, 3, 5 years. And right now, those forces are telling him something that should frighten every person in or approaching retirement in America. What they are telling him is this: the economic environment that generated the wealth in your retirement account is gone. The conditions that made the standard 60/40th portfolio a reasonable strategy are gone. And the era of essentially free money that inflated the value of every asset class, from stocks to bonds to real estate, over the last 15 years is gone, and it is not coming back. Here is the foundation of the problem. After the 2008 financial crisis, the Federal Reserve made a decision to take interest rates to essentially zero and hold them there for over a decade. Simultaneously, they created trillions of dollars through quantitative easing, buying government bonds and mortgage-backed securities to flood the financial system with liquidity. The intention was to prevent a depression. The result was to create the most artificially inflated asset environment in the history of capitalism. When money is essentially free, when you can borrow at 0%, every asset class inflates. Stocks went up, bonds went up, real estate went up, private equity went up, venture capital went up. Everything went up, not because the underlying businesses and assets were fundamentally worth more, but because money was cheap and there was nowhere else to put it. That was the world your retirement account was built in. That world is over. Starting in 2022, the Federal Reserve was forced to raise interest rates aggressively, the fastest rate hiking cycle in 40 years, to fight the inflation that all of that money printing eventually and inevitably caused. And now we are in a situation that Druckenmiller has described as the most reckless fiscal environment in the history of the United States. The numbers are not opinions. They are arithmetic. The United States is carrying over $36 trillion in national debt. debt that was accumulated largely during the era of zero interest rates. Now that interest rates are dramatically higher, the annual interest payment on that debt has crossed $1 trillion per year. $1 trillion every year just to service the interest. That is more than the entire defense budget. It is more than Social Security payments. It is a number that is growing every single month as older, cheaper debt matures and gets refinanced at higher rates. And it creates a structural fiscal deficit that Druckenmiller has said is essentially unfixable through conventional means. The only paths out are massive spending cuts, which are politically impossible, massive tax increases, which are economically destructive, or massive inflation, which is the quiet theft of purchasing power from everyone who holds dollars and dollar-denominated assets. None of those options are painless. All of them are profoundly disruptive to financial markets, and this is the foundation on which everything else that is about to happen is being built. Now layer the tariff situation directly on top of that fiscal foundation, and you begin to understand why Druckenmiller is focused on 2026 as the specific pressure point where this slow-motion crisis accelerates into something that moves fast, enough to permanently damage retirement accounts that are not properly positioned. The tariff program currently being implemented is the most aggressive trade intervention since the Smoot-Hawley Tariff Act of 1930. And if you know your economic history, you know that Smoot-Hawley helped turn a stock market crash into the Great Depression. I am not saying we are heading for another Great Depression. I am saying that the scale of the tariff intervention being applied to the world's largest economy is not a minor policy adjustment. It is a structural shock to global supply chains that has consequences that are still working their way through the system. Here is the mechanical reality of tariffs that most people do not understand. Tariffs are inflationary by definition. When you impose a 25% tariff on imported goods, the cost of those goods rises by roughly that amount, and those costs get passed through the supply chain and eventually show up in the prices that consumers pay. But they do not show up immediately. The full economic effect of a tariff shock takes 6 to 18 months to fully work through the supply chain and appear in consumer prices and in corporate earnings reports. We are inside that window right now. The tariffs that were imposed are beginning to hit corporate supply chains. The price increases are beginning to show up. The margin compression is beginning to appear in earnings, and this is happening simultaneously with a commercial real estate market that is facing a quiet catastrophe. Since remote work permanently changed the demand for office space, commercial real estate valuations have been deteriorating steadily. And now a massive wave of commercial real estate loans that were written at near zero interest rates are coming due for refinancing at interest rates that are 3, 4, sometimes 5 times higher than the original loan rate. The math on those refinancings does not work. Regional banks that are carrying those commercial real estate loans on their balance sheets are sitting on losses that have not yet been formally recognized. And when those losses surface, and they will surface, the stress on the regional banking system will be real and visible. Add to this the debt ceiling drama that Washington performs every year with increasing dysfunction. The stock market, that in many segments is still priced as though the era of free money is returning. And you have a specific convergence of triggers in 2026 that Druckenmiller has identified as the window where the gap between market pricing and economic reality closes, and closes hard. He is already positioned for this. The question is whether you have the first safe haven is gold. And before you dismiss this as the standard fear-mongering pitch that gets made every time markets look shaky, I want to give you the precise Druckenmiller framework for thinking about gold, because it is fundamentally different from how gold is usually discussed, and it is the difference between understanding why this move makes mathematical sense and just following someone's advice on blind faith. Most discussions of gold frame it as a hedge against inflation. That framing is partially correct, but it misses the more important point. Druckenmiller thinks about gold primarily as a hedge against fiscal irresponsibility and currency debasement. And those are related to inflation, but they are not identical to it. Here is the distinction that matters. Inflation is a general rise in the price level. Currency debasement is a specific erosion of the purchasing power of the currency itself. in this case, the US dollar. When a government is running structural deficits of $2 trillion per year and has no credible political path to closing those deficits, the long-term trajectory of the currency that government issues is downward. When the Federal Reserve has a history of creating money to monetize government debt, the long-term trajectory of that currency is downward. Gold priced in dollars rises in that environment, not because gold is becoming more valuable in some absolute universal sense, but because the dollar is becoming less valuable. You are not gaining wealth by holding gold in that environment. You are preserving it, which is the entire point. Look at what gold has done over the past 3 years. While the stock market has been volatile, while bonds have been losing value as interest rates rose, gold has quietly and systematically moved to multiple new all-time highs. And the buyer driving that sustained price appreciation is not the retail investor in Ohio or Texas. It is central banks, China, Russia, India, and dozens of other countries that are quietly and deliberately reducing their dependence on the US dollar as the world's reserve currency, have been buying gold at the fastest pace in decades. They are making a sovereign-level bet that the dollar's dominance is declining and that gold is the appropriate store of value to hold in its place. When central banks are the buyer, you do not fight that trend. You position alongside it. In terms of practical implementation for a person with a standard retirement account, the most straightforward approach is a gold ETF. GLD and IAU are the two largest, most liquid options. They track the gold price closely, they carry very low management fees, and they are holdable in an IRA or standard brokerage account without any of the storage and insurance complications of physical gold ownership. If you want amplified exposure to gold price movements, accepting both the upside leverage and the additional downside risk, large gold mining companies like Newmont and Barrick Gold expand and contract their profit margins dramatically as gold prices move, because their cost structures are relatively fixed while their revenue is directly tied to the gold price. Druckenmiller does not advocate putting everything into gold. He is too sophisticated a risk manager for that kind of concentration. But in his public commentary, he has indicated that a meaningful allocation, something in the range of 10 to 20% of a portfolio in the current environment, provides genuine, measurable protection against the specific scenario he is most concerned about. When everything else is under pressure, gold historically holds or appreciates. That is not a philosophical position. It is a 5,000-year empirical track record. The second safe haven requires the most careful explanation of the three, because it involves destroying a piece of conventional financial wisdom that has been repeated so many times and by so many financial advisors that most people have accepted it as unquestionable truth. That piece of wisdom is this: bonds are safe. As you approach retirement, move more money into bonds to protect yourself from stock market volatility. For the 40 years between 1982 and 2022, that advice was basically defensible. Interest rates were in a long structural decline during that entire period. When interest rates fall, bond prices rise. So a retiree holding long-term government bonds during those 4 decades was actually watching their bond portfolio appreciate in value while simultaneously collecting interest payments. Bonds genuinely functioned as a safe harbor in that specific rate environment. But here is the cold, hard mathematical reality that your financial advisor may not be telling you clearly enough. The relationship between bonds and safety only holds when interest rates are stable or falling. When interest rates rise, and in an inflationary high deficit environment, interest rates have powerful structural reasons to keep rising. Long-term bonds do not protect you, they destroy you. A 30-year Treasury bond loses approximately 18% of its market value for every 1 percentage point increase in interest rates. Read that sentence again. If you have $100,000 in long-term government bonds and interest rates rise by 2 percentage points, which is entirely within the range of plausible outcomes given the inflationary pressures currently building in this economy, that $100,000 becomes approximately $64,000 before that bond ever matures. That is a $36,000 loss on an investment that is marketed to you as safe. That loss is real. It is happening to real people in real retirement accounts right now. And most of them do not fully understand what is happening to them because they were told bonds were safe. And nobody told them that the safety guarantee had a critical condition attached to it. So what does the Druckenmiller framework prescribe instead? Two specific instruments. The first is short duration treasury bonds, treasury bills with maturities of 3 months, 6 months, or 1 year. Short duration instruments have minimal sensitivity to interest rate changes because they mature so quickly. If rates rise while you are holding a 6-month T-bill, you simply collect your principal when it matures and reinvest at the new higher rate. You do not suffer the catastrophic price loss that long-term bondholders experience. Right now, short-term treasury bills are yielding in the range of 4 to 5%. That is a genuinely attractive return for a near risk-free instrument, and it is the kind of return that allows you to preserve capital and generate income while you wait for the broader situation to resolve itself. The second instrument is Treasury inflation-protected securities, known as TIPS. These are government bonds where the principal value adjusts upward automatically with the rate of inflation as measured by the Consumer Price Index. If inflation runs at 4%, the principal of your TIPS investment grows by 4%, and you earn your interest rate on that larger principal. In an environment where tariffs are mechanically pushing import prices higher and where the structural deficit practically guarantees some level of ongoing inflation, TIPS are one of the very few bond instruments that actually does what people think all bonds do: protect your purchasing power. The practical message is simple and non-negotiable. If you are holding long-duration nominal bonds, 10-year, 20-year, or 30-year, treasuries or bond funds that hold them in your retirement portfolio, you need to understand the risk you are carrying, and you need to seriously evaluate moving into short-duration T-bills or TIPS. This is not glamorous. It will not generate the kind of returns that make for an exciting quarterly statement, but it will prevent the kind of loss that can take 5 to 10 years to recover from. And in retirement, 5 to 10 years is not an abstraction, it is your life. The third safe haven is where Druckenmiller's thinking separates from simple capital preservation and moves into actually growing your money in an environment that will destroy the wealth of investors who are not paying attention. And the concept at the center of this third safe haven is pricing power. Two words that should be tattooed on the inside of every serious investor's eyelids because they are the single most important characteristic a business can possess in a now inflationary, high-cost economic environment. Pricing power is the ability of a company to raise its prices without losing its customers. And it sounds deceptively simple, but its implications are profound, and its presence or absence in a business is the single biggest determinant of whether that company's stock holds up or collapses when economic conditions deteriorate. Here is the mechanism. When inflation is running hot, when tariffs are raising the cost of raw materials and components, when labor costs are rising, every company faces the same input cost pressure. The companies that have pricing power that can pass those higher costs directly through to their customers without losing significant business maintain their profit margins. Their earnings hold up. And because their earnings hold up, their stock prices hold up even as the broader market struggles. The companies that do not have pricing power, commodity producers selling undifferentiated products, retailers competing on price in crowded markets, businesses whose customers have dozens of credible alternatives, those companies get squeezed. They cannot raise prices without losing customers. Their margins compress, their earnings fall, their stock prices follow. The sectors where pricing power is structural and essentially permanent are the sectors where Druckenmiller concentrates his defensive positioning in environments like this one. Healthcare is the most critical for the audience of this channel. Healthcare spending in America is not discretionary. It is demographically driven and medically mandatory in a way that no other economic sector can claim. The baby boomer generation, the largest generation in American history, is now fully in its retirement years, and the demand for healthcare services, prescription medications, medical devices, hospital systems, and elder care facilities is going to grow relentlessly for the next 20 years, regardless of what the stock market does, regardless of what interest rates do, regardless of what any administration's economic policy looks like. You cannot choose not to need your blood pressure medication because the Dow Jones dropped 30%. You cannot decide to postpone your cardiac procedure because the Federal Reserve raised rates. Healthcare companies with dominant positions in essential treatments have pricing power that is structurally embedded in the biological reality of human aging. And that is why healthcare stocks have historically been among the strongest performers during recessions and inflationary periods. Energy is the second major sector, and the tariff environment makes the case for domestic energy producers even stronger than it would be in a normal inflationary cycle. When tariffs disrupt global supply chains and create uncertainty about the international movement of oil and gas, domestic energy producers benefit from both higher prices and a structural advantage over imported alternatives. When oil moves from $80 a barrel to $100 a barrel, the profit margins of domestic producers expand dramatically because their production costs are relatively fixed. Their revenue rises. Their earnings expand. Their stocks follow. Consumer staples form the third pillar. These are the companies that produce the products that people purchase every single week, regardless of whether the economy is growing or contracting. Food, household cleaning products, personal care items, the fundamental necessities of daily life. The demand for these products is what economists call inelastic, meaning it does not change significantly in response to price increases or economic downturns. People cut their vacation budgets when times get hard. They eat at home instead of restaurants. They cancel subscriptions. They do not stop buying toothpaste. They do not stop buying laundry detergent. They do not stop feeding their children. Companies like Procter & Gamble have demonstrated through multiple recessions and inflationary cycles across decades the ability to raise prices consistently and maintain their customer base because there is simply no credible substitute for the products that people need every day of their lives. What Druckenmiller explicitly avoids in this environment is equally instructive, and it directly addresses the most dangerous positions that most American retail investors are currently holding: highly speculative technology stocks, the companies that carry enormous market capitalizations relative to their current earnings, whose entire investment thesis depends on a future growth story that has not yet materialized, were priced for a world of zero interest rates and unlimited cheap capital. In a world of higher rates and persistent inflation, the discounted value of future earnings falls dramatically, and the valuations that made sense in 2020 and 2021 simply do not make mathematical sense in 2025 and 2026. The practical implementation of this safe haven for someone with a standard retirement account is not complicated. Look at your current portfolio. If you are heavily allocated to broad technology-focused index funds, if you hold significant positions in high-price-to-earnings growth stocks, consider a deliberate rebalancing toward healthcare ETFs, energy sector funds, and consumer staples ETFs. These sectors trade at lower valuations, generate real current earnings, pay real dividends, and carry the structural pricing power advantages that will allow them to hold value and generate income through exactly the kind of economic environment that is now being constructed around us. I want to close with something that I believe is the most important point in this entire video, and it is not a chart or a ratio or a specific ticker symbol. It is a structural reality about the different kinds of risk that retired investors and younger investors face when confronting the same market event, because understanding this difference is what makes everything Druckenmiller is saying land with the urgency and the seriousness it deserves. When you are 35 years old and the market drops 40%, you have a problem that time solves. You keep contributing to your retirement account. You buy more shares at lower prices. You wait 10 years, The market recovers and you're fine, often better than fine because you bought through the bottom. When you are 65 or 70 years old and drawing down your savings to fund your living expenses, a 40% market drop is a fundamentally different kind of problem. You are forced to sell assets at the bottom to pay your bills. You are locking in those losses permanently. You may not live long enough to see a full recovery, and even if you do, the years of drawing down a depleted portfolio at the bottom will have permanently diminished the total wealth available to you. That asymmetry is why Druckenmiller's three safe havens, gold and hard assets, short duration bonds and tips, and companies with genuine pricing power in essential sectors, are not optional portfolio adjustments for people in or approaching retirement right now. They are the defensive formation of a disciplined investor who has stared down every kind of market crisis for 30 years and knows exactly what it looks like when a structural shift is underway. The tide is going out. The question you need to answer today, not next month, not after the next earnings season, not after the next Federal Reserve meeting, is whether your portfolio is positioned to survive what is coming, or whether you're going to spend the next decade trying to recover what you lost instead of living the retirement you earned. Subscribe to this channel right now. Drop a comment below telling me which of these three safe havens you are already positioned in and which one surprised you the most. And I will see you next week with the next piece of intelligence that the smart money does not want you to have.